Hedge, I'm Aiwe, and today we are talking about Leopold Aschenbrenner's leveraged AI fund and the hedge that may not hedge. If you enjoy stories like this, hit the like button and subscribe if you haven't already. Let's go. Imagine being right about the future and still losing everything before that future arrives. That is the danger this story puts under a microscope. We will examine how a powerful technology thesis can become a fragile financial position, why a long and a short can secretly be the same bet, and what leverage does when the market refuses to wait. Act 1. Survival comes before prediction. Start with $100. If it falls by half, you have $50 left. To return to 100, you do not need a 50% gain. You need a 100% gain. The larger the loss, the steeper the climb back. This simple arithmetic is the first principle of leveraged investing. Survival is not a side issue. It is part of the return. A fund can have positive expected returns and still produce terrible outcomes for its investors. Gains and losses compound along a path, not inside an average. A strategy may look attractive in a spreadsheet because its best possible outcomes are enormous, while the ordinary paths are damaged by volatility, financing costs, and forced selling. That leads to a central question. What happens when a compelling forecast about artificial intelligence is converted into a concentrated public market portfolio borrowed against by prime brokers and funded by people whose own careers and wealth already depend on artificial intelligence? Act 2. The hedge that may not hedge. A conventional long-short equity fund is designed to separate two ideas. The manager buys companies expected to outperform and shorts companies expected to underperform. If the entire market falls, losses on the long positions may be offset by gains on the shorts. In theory, the broad market matters less, leaving the manager's stock selection to drive results. But labels are not enough. A hedge works only when the positions respond differently to the risks being managed. Consider a fictional portfolio that owns semiconductor manufacturers and shorts software companies. Those positions look opposite, yet both may depend on the same expectation: rapid artificial intelligence spending and rising technology valuations. If investors begin to doubt the speed of that growth, the chip companies may fall. The software companies may rise if traders view them as more defensive, more profitable, or simply less exposed to expensive infrastructure. The fund then loses on its longs and loses again on its shorts. It has reduced some market exposure, but increased exposure to one economic narrative. This distinction matters in the reported episode involving Leopold Aschenbrenner. Publicly documented facts include his work at the FTX Future Fund, a later role at OpenAI, and his departure from that company in 2024 after a disputed episode involving security-related information. He also published Situational Awareness, an influential essay about artificial intelligence, compute, national security, and possible rapid progress. The essay helped establish Aschenbrenner as an important voice among parts of the technology and venture capital communities. But influence in forecasting is not identical to experience in trading. An investment portfolio must answer questions that an essay does not. How much can be lost? How quickly can positions be sold? What happens if the forecast is early? Who supplies cash during a drawdown? Act 3. Leverage changes the clock. Leverage means using borrowed money or borrowed exposure to control a larger position than the fund's own capital could purchase. It can be sensible when assets are stable, liquid, and only modestly profitable. Borrowing may turn a small, repeatable return into a useful one. The danger arises when leverage is applied to volatile, crowded positions. Prime brokers require collateral. When prices fall or volatility jumps, they can demand more collateral. If the fund cannot provide it, the broker may reduce or liquidate positions. Selling under pressure can push prices lower, creating another margin call and another round of selling. This is why timing can matter more than a long-term thesis. Suppose an investor believes artificial intelligence demand will be enormous over the next decade. That belief may turn out to be correct. But if the portfolio loses enough in the next month to trigger liquidation, the investor no longer owns the position when the long-term payoff arrives. The mathematics of compounding makes the problem worse. A 50% loss requires a 100% gain to recover. Repeated swings can reduce wealth even when the simple average of the swings looks positive. A common approximation says that long-run compounded growth is expected return minus 1/2 of variance. It is only an approximation, but it captures the cost of unstable paths. Leverage magnifies that instability. Exposure can increase the size of gains, but it also increases the size of losses, financing costs, and collateral demands. The exact relationship depends on the instruments, portfolio construction, and broker agreements. Gross exposure, net exposure, and notional derivatives exposure are not interchangeable. Any dramatic figure must be checked against those definitions. Act 4. When the story becomes a portfolio, the reported fund episodes should be treated carefully. Public accounts have circulated claims about the firm called situational awareness, its size, its leverage, its losses, its investors, and possible transactions involving its portfolio. Those specific numbers and the relationships require confirmation through filings, investor communications, court records, broker disclosures, or multiple reputable reports. What can be analyzed without accepting every reported figure is the mechanism. A concentrated artificial intelligence trade can lose in several ways at once. Semiconductor demand can be repriced. Software shares can rally against a short position. Interest rates can change valuation multiples. Crowded investors can rush for the same exit. Financing can become less available precisely when it is most needed. There is also a portfolio problem for the investors themselves. Technology funders and executives may already own startup equity, stock options, company shares, and income tied to the same sector. Investing in a concentrated artificial intelligence fund may be a deliberate speculative choice, but it is not conventional diversification. It adds another layer to an existing exposure. This is not an argument that young managers cannot succeed or that concentrated investing is always foolish. Age is not a risk metric. Concentration can be rational when an investor has a real edge, limited leverage, adequate liquidity, transparent controls, and enough time to be long. The issue is the combination. One theme, correlated positions, borrowed exposure, uncertain liquidity, and investors who may share the same underlying vulnerability. Each ingredient can be manageable on its own. Together, they can turn a temporary disagreement with the market into permanent capital loss. Act 5. The advantage of boring infrastructure. Established hedge funds and prime brokers are not protected from bad forecasts. Their advantage is different. They often have teams measuring concentration, counterparty exposure, scenario losses, liquidity under stress, and the amount of collateral required if markets move rapidly. That infrastructure can look wasteful during a rising market. Risk committees slow decisions. Position limits prevent the biggest possible bet. Cash earns less than a fully invested portfolio. But during a disorderly sell-off, those constraints can preserve the ability to wait. If a large public equity portfolio was later sold to an established trading firm, the transaction should not automatically be called a rescue. It may have been an auction, a purchase of selected positions, or an arrangement with complicated financing and liability terms. The important analytical point is that distressed portfolios are valuable to buyers with capital, information, and patience. Illiquid private company holdings create a final complication. They may not face the same daily price movements as public shares, but a stable reported valuation is not the same as cash available in a crisis. Private assets can cushion a fund's marks while simultaneously preventing it from raising money quickly. The larger lesson crosses three cultures. Technology asks what can be built. Venture capital asks how large the opportunity could become. Institutional finance asks what happens if the forecast is delayed, overpriced, crowded, or impossible to exit. None of those questions is wrong. They simply describe different disciplines. A brilliant thesis is not a robust portfolio. A high expected return is not a guarantee of survival, and being early can look exactly like being wrong when the financing clock runs out fast. The market does not reward conviction by itself. It rewards positions that remain alive long enough for conviction to matter. So when you hear that a trade was hedged, ask what risk the hedge was actually designed to remove. When you hear a spectacular performance number, ask how much leverage and how much liquidity made it possible. And when a future sounds inevitable, ask what happens if it arrives 1 year later than expected. That is the difference between forecasting a transformation and financing one. If this analysis helped clarify the mechanics, consider subscribing for more evidence-based explanations of markets, risk, and financial history. And before treating any dramatic account as fact, check the documents behind the numbers.